Good morning and welcome to the 2020 Structured Finance COVID-19 edition of DBRS Morningstar's Credit Insight series. I'm Tim O'Neill on behalf of the panel speakers, Susie Calder, Terry Ritchie, Paul Bretzlaff, and King Lam. Thanks so much for taking time out to listen in. But don't worry if you need to sign off before it's over due to other commitments or distractions such as picking up your kids for lunch, internet outages, Amazon deliveries, or even changing that load of laundry. Please know the session is being recorded and the replay link will be distributed as soon as it's available. So here we are in December, still working from home, most of us, Terry, and back into lockdown in Ontario and other parts of Canada. If the severity of the impact on the economy of a new virus officially declared a pandemic last March was extreme, so too was the response by central governments around the world. From a position of strength relative to the 2008 financial crisis, the depth and breadth of the government's response can be demonstrated with one simple statistic. By November of this year, the combination of government support directly and personal incomes in total is greater in Canada and the US than levels were prior to the start of the pandemic. Similarly, so too did our ratings process have to adapt to the severity of the crisis. Fortunately, the economy stayed closed down through the spring, and we literally had nothing else to do. Our first step was to be as proactive as possible to get out and get the information from issuers and conduit sponsors rather than waiting around for the data to come in through various servicer reports. The second part of our process was to incorporate more frequent input from our sovereign group on the economic indicators forward-looking to 2022, which include mainly unemployment and GDP. The most recent update was published yesterday and is available on our website. I'm very proud that the team was able to quickly publish a sensitivity analysis by April 9th on the impact that monthly payment deferrals offered to consumers and on the impact they would have on the outstanding ABS transactions that we rate. This allowed us and investors to get ahead of any potential rating impacts as deferral amounts were offered rather than waiting for potentially up to 1 or 2 months delays for the servicer reports to get filed. To date, we are pleased to report that so far, transactions continue to hold up well, primarily due to the extent of federal support directly through programs such as the CERB and its successors, and lots more coming as recently announced by the Liberal government this week. Also indirectly through liquidity facilities set up by the Bank of Canada that provided expanded term repo lines, including more ABS asset classes, which provided liquidity to the financial system. The transactions we rate have also performed well due to structuring that includes cash and excess spread to provide liquidity for short-term deferral spikes, and by the fact that we predominantly rate AAA transactions, which are characterized by weighted average credit scores that are much higher than the national averages. This means performance should be stronger than the general economy. However, we will continue to monitor very closely as we persevere through another lockdown and struggle through what currently looks like a pretty bleak winter. In the first part of today's session, where I got to multitask here and go to the presentation I'm sharing and flip a page. I'm not doing that very well right now. But in the first part of the session, King and Paul will discuss what their experience so far has been in rating consumer asset classes in the auto loan and lease sector, and also covered bonds, credit cards, and residential mortgages. Before that, just a quick idea of the numbers so far this year in the ABS markets. The ABS market of 28 transactions year to date last year is only 14 this year, for a decline of about 7 billion, slightly offset by ABCP, which is up about 4 billion. So the net down this year is about 2.5 billion. With that in mind, King, what are your thoughts and what maybe help us out with your experience so far this year in this unusual situation?
Sure. Thank you, Tim. I think I'll just start by going through some of the additional considerations that we've taken since the COVID-19 pandemic, which starts on slide 4. So at the onset of the pandemic, there was a lot of uncertainty and things were developing at a rapid pace. And one of the first things we did was to reach out to issuers to check in on how they were doing. And we asked, how they've been impacted by the current events, whether they've had any issues transitioning their staff to work from home arrangements. Are they experiencing any payment issues from customers? And are they offering any types of payment relief programs to support their customers over this time? What we found was that most issuers were offering payment deferrals to customers in need. And typically, for anyone who asked for a payment deferral, they were granted one, which meant that they didn't have to make a payment over the deferred period. From a securitization standpoint, this could have potentially caused a liquidity issue in transactions. So to assess the risk, we evaluated the amount of cash and excess spread in rated transactions to see how much protection was available. And overall, we concluded that there was sufficient protection against the risk. In some cases, there was sufficient excess spread to support up to 80% customer deferrals being granted from a liquidity standpoint. And we summarized our analysis in a commentary we published at the beginning of April. And later, you'll see that actual deferral rates were much lower. And finally, we retested all our transactions at the beginning of the pandemic to determine if any rating actions were necessary. Our evaluation incorporated the macroeconomic scenarios that were published by our sovereign group, which included unemployment and GDP growth scenarios through 2022. On the next slide, you'll find the initial impact the pandemic had on the retail auto sector. This sector was temporarily disrupted by regional shutdowns imposed by local governments. For example, from late March to most of April, sales departments of car dealerships were ordered to close in Ontario and Quebec. And at the same time, physical car auctions such as Mannheim and Odessa were closed as well. These impacted the origination and remarketing aspects of the industry. In response, servicers took various measures to address the disruptions. They offered payment deferrals for customers who were affected. This gave them more time to get back on their feet. And for retail leases, extensions were offered in some cases. Since dealerships were closed temporarily, the extensions gave customers time to shop for their next car when showrooms reopened. This also helped the finance company since remarketing channels were disrupted. And extending the lease maturities meant they didn't have to take back lease vehicles at a time when it was difficult to sell them. Also, to offer more compassion to their customers, there was a moratorium on vehicle repossessions at most companies through June. The next slide shows the reported deferral rates from issuers in the retail auto sector. Some issuers added payment deferral rate information to their monthly service reports since the pandemic, and we've been tracking it closely. Most issuers in the auto sector offered customer payment deferrals of up to 3 months, and only in limited cases did issuers grant a second deferral. Based on the payment deferral rates published, we can observe that they peaked in the months April to June and have been gradually declining as deferrals expire. For retail auto loans, average deferral rates in securitized pools were as high as 8 to 9% in May and June and have declined to less than 2% in September. For auto leases, deferral rates were lower. Average deferral rates never exceeded 5% of securitized pools and have declined to almost zero by September. It's important to note that excess spread available had no issues protecting transactions from payment deferral risk. And compared to our liquidity analysis from April, the actual deferral rate experience was significantly lower than the break-even levels we calculated. Performance of auto loans and leases have remained strong since the pandemic. The combination of government support and payment relief programs have undoubtedly helped customers get through this stressful time. And one of the encouraging signs we've observed is that most customers who receive payment deferrals have been able to resume making payments when their deferrals ended. And very few were granted second deferrals or fell delinquent. The strong performance is reflected in delinquency and loss rate levels of transactions, which are presented on the next slide. From a delinquency standpoint, they remained low through September. For auto loans, delinquencies have trended more or less the same pre and post pandemic. And for leases, there's a brief jump in delinquencies in April and May, but they've since declined back to pre-pandemic levels. On the next slide, you'll see that there hasn't been a significant change to loss rates since the pandemic. They've remained low, but we continue to keep a close watch on losses as government support and payment relief programs expire. And finally, on the next slide, you can see how residual values performed in lease transactions. There continues to be gains on residual values. Other than a brief dip in April, due to the disruption in remarketing channels, residual value gains have rebounded and are trending higher than pre-pandemic levels. And with that, I'll hand it over to Paul, who will speak to residential mortgages, covered bonds, and credit cards.
Great, thanks, King. So starting with residential mortgage transactions, lenders provided up to 6 months of payment deferrals to borrowers affected by COVID-19. Typically, the initial deferral period was 1 to 3 months, after which borrowers could reapply. Deferrals generally peaked in May or June during this initial deferral period. It reached as high as 20% for some prime portfolios and 30% for some Alt-A portfolios. After this initial deferral period, percentages came down a little as not all borrowers reapplied, and some borrowers had requested the initial deferral as a precaution. As of September, deferrals were down to single-digit percentages as programs are ending and lenders are typically not offering new deferrals. And if you look at several lenders who have reported numbers as of the end of October, their remaining deferrals are now less than 2%, so they are largely winding down. Both RMBS and ABCP transactions had sufficient liquidity during the peak deferral months and continued to make timely interest payments. For RMBS transactions, they were largely supported by servicer advances, where the servicer advanced the amount of deferred payments to the trust, in addition to having excess spread. And for ABCP transactions, they had sufficient excess spread, in addition to a seeded cash reserve if they needed it. Mortgage pool performance continued to be very strong. To give you an idea, out of the 4 outstanding public RMBS transactions, only 1 loan out of those 4 transactions has ever defaulted, and there have been no losses. Currently, no delinquencies in those programs. And for ABCP programs, it's a similar story. Weighted average delinquencies and defaults have remained below 10 basis points, and there have also been no losses. And so far as borrowers come off their payment deferral programs, they have largely been able to begin making payments. Finally, with respect to new issuance, historically there haven't been many RMBS transactions in Canada, and there were no new RMBS issuances since the onset of the pandemic. But leading up to March, Prism Trust issued its first series right at the end of February, and Classic launched its second transaction in 6 months, which was scheduled to close in March. However, as the pandemic began, the transaction was delayed and didn't end up closing. And for ABCP, there were no new programs. However, funding remained strong and actually increased slightly from $10.5 billion in March to $11.2 billion at the end of September. Moving on to covered bond issuance, we saw record issuance at the beginning of the pandemic, and this really was supported by 2 temporary regulatory changes that were made in March. So the first was that the Bank of Canada added covered bonds as an eligible security for its repo operation. And the second was when OSFI increased the covered bond limit from 5.5% to 10%. And these changes were made to help support the economy with liquidity. And the Canadian banks were proactive and started accessing this liquidity right away. There was $116 billion new issuance from March to June, and most of it really occurred in the first 2 months in March and April. $92 billion was Canadian dollar denominated. So these are the covered bonds that were eligible to be repoed. And to give some context, the $124 billion issuance in 2020 year to date is 3 times the highest annual issuance of any other year. Issuance has slowed significantly since June. There have only been 2 covered bond issuances. And in October, the Bank of Canada removed covered bonds as an eligible security for its repo operations. And finally, moving on to credit cards. So credit card lenders also provided various forms of payment relief, which included payment deferrals. Some also provided reduced interest. Generally, rates were reduced in half from 20% to 10%, more or less. Payment deferrals for most programs peaked in the mid-single-digit percentages, and there were even less interest rate reductions as only a subset of borrowers who received a payment deferral also received the reduced interest rate. They didn't necessarily receive both. Deferrals are now less than 1% for all the programs. Transactions had sufficient liquidity to make interest payments. Not only were peak deferrals low, but excess spread is high for credit card programs, and they can support a significant amount of payment deferrals from an interest rate payment standpoint. With respect to performance, payment deferrals and rate reductions didn't have as large of an impact to payment rates or yields as they were low, and also especially since in some programs, the seller deposited any reduced interest amounts to the trust. It was more that purchases decreased in April and May. And so this led to lower interchange and therefore lower yield, and also lower payment rates as well, as the borrowers who repay in full each month were charging and therefore repaying less. Purchases have returned to normal since June, and yield and payment rates have picked back up again. In terms of delinquencies and losses, there was a slight increase in March and April. However, the ongoing government support has helped keep delinquencies and losses low since then, and we are currently below pre-pandemic levels for losses and delinquencies. And finally, ABS issuance is down significantly. We have seen issuances from Eagle and Glacier in August and September. These are the PC Bank and Canadian Tire programs. But the bigger banks have largely been inactive. Typically, in a given year, the amount of note maturities give somewhat of an indication of the amount of new issuance there might be. But in 2020, the big banks have not been refinancing maturities, which just speaks to their availability of cheap funding options. So that covers the impact of COVID-19 on some of the major asset classes.
Thanks, Paul. I'm pretty excited to get to the next session, and not only because it means I can stop screen sharing soon, but I'll leave up the backgrounds of Terry and Susie, who have really appreciate them taking the time out of their extremely busy schedules to share their experiences from not only a liquidity and conduit sponsors, but also in the ABCP market, but also on the ABS side. And we'll start out with Terry, just asking sort of what kind of actions and how did the whole thing play out for you as a conduit sponsor and sort of protecting those note holders?
Yeah, thanks, Tim. Fortunately or unfortunately, a lot of the people who were dealing with this crisis had dealt with the financial crisis that we went through in 07 and 08. So a lot of those experiences directed what our principal concerns were when things started to go into lockdown in early mid-March. And so, the natural things that you look at, where do we have risk in our transactions? How are they going to perform? But also, a major problem from the earlier financial crisis was the ability to place ABCP. So there was a real concern again, how is this going to impact our ability to fund our transactions? Fortunately, there was a real difference between a pandemic and the financial crisis that we experienced before, which was driven by or had as a principal component of it a lack of confidence in securitization product because of the fact that the subprime assets that were backing securitization product that failed was a principal cause of that earlier financial crisis. So we saw funding markets far less certain in that crisis, whereas in this situation, this was clearly a crisis that the concern is going to be more on the impact on consumers due to locking down the economy, that sort of thing. Are consumers going to be able to make payments on their assets as opposed to a lack of confidence in securitization product? So we didn't see that same impact on ABCP markets. We did see, as you would expect at any time there's a shock to the financial system, some cautiousness. So our ABCP rolls shortened, and we saw spreads widen somewhat. But we did not see that ballooning of inventories that we'd seen in the prior crisis, and we didn't see spreads balloon out to the same degree as they had in the prior crisis. So the reasons for this, again, a principal difference between what was the cause of the crisis, but also I think the government and the Bank of Canada in particular had also learned from the earlier crisis. So as you mentioned earlier, Tim, their programs I found to be quite effective, and they brought them online really quick. So again, looking at the nature of this crisis, a concern over the ability of consumers to make payments, whether it be mortgage payments or auto loans or leases, was addressed quite quickly by bringing in the emergency response benefit or CURB to put money into consumers' hands for them to be able to make their payments. The other thing that I found really a benefit was the Bank of Canada acting quickly to adjust the term repo facility to be able to for financial institutions to be able to pledge assets that are eligible under the standing liquidity facility, but also not repeating a mistake from the earlier crisis. This time around, they allowed banks to be able to pledge their own ABCP. I found this to be a big injection of liquidity into the market at really cost-effective rates, and I think that had a big impact on not seeing spreads widen, and certainly had an impact on banks not having to expand their inventories, and I think and hope it gave confidence to ABCP investors. So again, we didn't see that by getting money into the hands of consumers. The term repo facility, I found the government response quick and effective. In terms of impacts on specific transactions, again, when you have an event like this, you immediately look at your transactions to say, okay, where are our risks lying that maybe we weren't thinking about? And it's interesting. I mean, it's been touched upon a couple of times already. Deferrals became a big issue where I don't think a lot of thought had been given to deferrals before then. Most transactions contain a limit on the number of deferrals that a contract can have by limiting how many months it can be extended. But I don't think people thought a lot about how deferrals are handed out. And in most cases, a business as usual monthly deferral rate would be, speaking about autos, but I assume mortgages would be similar, would be something less than 1%. And are really only granted on individual cases where some sort of unexpected event has happened in the case of that obligor, such as a loss of job or something like that. Or, I think more common in the U.S. than in Canada, you get a flood or something like that, so you'll get deferrals in connection with people who are impacted by some environmental occurrence. At any rate, so that became a principal concern, and certainly in our discussions with the rating agencies at that point, it was a concern of theirs as well, and how for transactions that we maybe were working on at that point, how would they be able to address the two principal concerns that came out of it, which is, would there be sufficient cash flow to support the monthly costs of the transaction, and are deferrals being used as a means to mask a potential bump in delinquencies and defaults down the road. So in terms of what we did to transactions we were working on, we added additional enhancement, but we added it in the form largely of a bump in whatever the normal reserve would be. So I would say we added between 50 basis points and say 75 basis points of additional cash. So that would be money on hand to the extent that there was a concern over monthly cash flows. We also had bumps in OC as well, but I'd say the principal focus was on enhancement increases, was to get some additional cash into the transaction. The other thing, again, focused on deferrals and a concern over just what the deferral rate may go to. We put in place some specific deferral risk provisions. I would say the most common was a buyback obligation by the seller to the extent that deferrals exceeded either a particular monthly rate or a cumulative rate. I think both were used. And I think as King talked about, and speaking, really from an auto perspective, deferrals, well, firstly, just based on the normal structuring of a transaction, when you modeled it out, the amount of deferrals that a transaction would need to actually jeopardize the monthly cash flows is in the 50 or 60, maybe 70% range. Like it was huge. And in terms of where we would set the repurchase obligations, was substantially quite lower than that, say 15% monthly rate sort of thing. And we never came close to it, notwithstanding, the deferrals that programs that the finance companies were offering. There is a penalty to deferrals. I think that came up, especially in the news around mortgages, that deferrals are not free and that there is a cost to the obligors. So we didn't see anything like that, as I think King talked about on the lease side, maybe a monthly high of around 5%. On the auto loan side, the highest maybe would have been 9 or 10%. And those were during the months, half of March through April. And by May, the CERB program had come on hand, so consumers had money in hand, plus we were seeing the wind down of these deferral program offers. So I would say by the end of May, we were significantly approaching the business as usual normal levels of, say, 1%. And as King indicated, by the end of the summer, we've largely returned back to normal levels. And although the pandemic is still continuing and there's a lot of rough days still ahead, these extra measures that we've put in will remain in place, but they really haven't come into play at all. All the transactions have performed well. And I can see in 2021, jumping ahead to another discussion point, I can see in 2021 amendments to start to remove some of these extra protections that we put in place.
Right. And just on those deferrals, I mean, we definitely, the structuring in the auto and other transactions where, amortizing, non-amortizing enhancement and deleveraging structures really helped. So the more seasoned that transaction is, the more room it has for those deferrals as the cash amount stays at a high level throughout the life of the transaction, notwithstanding the repayments. So, and on the mortgage side, we saw deferrals, some of the non-bank issuers providing, sort of asking their clients that were asking for deferrals in March, asking to reapply again in April, and sort of on a monthly basis reapplying, as opposed to giving on the auto side is a little bit more of a sort of a 3 months deferral program. Susie, on the what's the RBC experience in terms of did Terry miss anything?
No, not that I'm aware of. Same sort of idea at RBC. I kind of look at it on different stages. That initial stage where everybody was somewhat in panic and trying to figure out what was going on, and all the companies were setting up their deferral programs. So you're in as a banker, constant communication with your issuers to find out what are they doing, what are they seeing, what are they hearing from their customers, and then also getting constant calls from investors and also reaching out to investors directly to try to reinforce and re-explain all the liquidity and support features, in RBC's case, the program-wide credit enhancement that is in play outside of the underlying transactions to support the facilities themselves, the ABCP facilities, and just to reconfirm how we've structured these conduits to support any transactions and all transactions within them. So that was that kind of initial phase, as Terry mentioned, that initial March, early April phase. And then once all the CERB and government programs started coming in, and we understood more of what kind of programs the underlying issuers were going to offer on deferrals, then we were almost into a steady state phase where we could then look at each of our underlying transactions. What do we need to do? Do we have enough enhancement? Do we need to change anything? Do we need to make any tweaks? Are there any waivers or amendments that need to be made? And that's where we took the time to do that in a measured approach. And I would, again, agree with Terry that once we entered kind of June, July-ish, we definitely saw that really normalize and the deferrals come down dramatically. We were still in constant communication with our issuers and investors and just seeing where things were at. And I'd say now that we are, well into winter now, especially in Toronto with the snow we've seen this week, we are going to see what happens as these government programs continue to roll off. Will we see an increase in losses? I don't know if we will, because I think enough has opened back up, even though we're back in lockdown in certain areas, that we might see a slight bump in the delinquencies and then to losses, but not dramatically. And I think we've got enough, especially within our programs, whether it's through any amendments or waivers or through the underlying overall ABCP structure of the conduits themselves, that really protect the investors from losses. And
that's the only thing I'd like to just add. Fully agree with everything Susie said. But as King pointed out earlier, the other issue that we were worried about, this use of deferrals to delay a big bump in delinquencies and default, we have not seen that at all. Any issuer we talk to or seller we talk to, that percentage that was delinquent before they went into deferral has kind of stayed delinquent, but anyone who was making regular payments, took a deferral, they've started making their regular payments again. So we've not seen that bump.
Yeah, we've seen it in our discussions where they've come back to almost 98, 99% of a normal deferral process. So that's good news. Maybe Susie or Terry on the U.S. side. Susie, you launched a new Pure Grove conduit only maybe a month ago. So how are things on the U.S. side in terms of ABCP?
Yeah, I'd say U.S., not a surprise, bounced back quicker than Canada did in terms of seeing spreads come in. I know Terry mentioned that our spreads didn't go out quite as wide as they did back from 2007, 2008 days. They still did go out dramatically, but I call them dramatically. But the U.S., not a surprise, came in a lot quicker than we did. We're able to sell out, and we followed suit. So I would say we were maybe 2-3 weeks behind in terms of spreads coming back in again. And, investors are still buying out to term. So that is not a problem anymore in Canada or the U.S. But I'd say things in the U.S. are great, and we'll get to the ABS side in a minute. But yeah, there's no concerns in the U.S. We did launch this Pure Grove funding conduit that has the ability to issue both U.S. and Canadian liabilities and can accept U.S. and Canadian assets. So we're able to pick up on any FX benefit for that for our Canadian issuers.
Yeah, there definitely seems to be a pricing advantage currently to ABCP in the U.S. Terry, is that right? Sort of what you're seeing on the GTA side?
Yeah, so GTA's only been online less than 2 months now, and but as we were contemplating its launch, we were watching the ABCP markets in the U.S. quite closely through the March-April period as well. So I fully agree with what Susie said that the U.S. market, again, you saw that the normal reaction you'll get in any time of the onset of a financial issue where rolls shortened, spreads widened out, but there was nothing like what we saw in 07, 08 where markets truly locked up. The market continued to operate and came back online quite quickly.
And okay, so Susie, you mentioned we would get to ABS. Let's turn to that now at 11:47. You led quite a few ABS transactions this year in Canada, probably in the U.S. as well that I'm not as familiar with. How are things looking in terms of this year relative to prior years? Looking at demand from Canadian U.S. investors and pricing and kind of trying to execute a deal in a COVID environment.
Yeah, well, I think it followed similarly to the ABCP environment where you have different phases. So initially, everyone just stopped. And that also, if you look at the corporate bond market in March, everything stopped. And in the U.S., everything stopped. And then April, if you look at the corporate bond market, April and May, it was record month, highest in history, and has remained very strong. And in the U.S. ABS market, same thing. You saw, not record, but you saw a lot of deals start happening in April, May, and this continued strong. I would say the Canadian ABS market has been a lot slower to rebound. And I think it comes to something Paul said. People have other ways of getting costs of funds, their funding costs or funding needs. They don't need to come to the ABS market if they don't need to. And so we saw a lot less volume. You mentioned at the beginning of the presentation that volume for ABS is dramatically down than in past years. So post-COVID, when we look at third-party deals, we've only seen 4 third-party transactions post-COVID. And so that would be Eagle, Glacier, the GM deal, and the Ford deal. So we've only seen 4 main deals. And that just isn't the same volume we'd like to see and are used to seeing within the Canadian ABS market. Now, again, I think it goes to the fact that people can go and issuers can go to other sources to get cost of funds funding, and they can also access the ABCP market. A lot of issuers have access to the ABCP market in Canada, and that's easier and quicker and more assured of getting their funding quickly. Now, on the 4 transactions we did see here in Canada, there is definitely an imbalance between supply and demand, and oversubscription levels were through the roof. So very high demand for the 4 deals. We even saw Ford do their largest deal ever at $742 million. So very, very successful. All 4 deals have been very successful. Pricing is now in or at pre-COVID levels, and that's similar for corporate. I mean, it all depends on what sector you're looking at. And in the U.S., you're seeing the ABS market just do very well, and the pricing is through pre-COVID levels in most sectors. Now, when we look at investors on the Canadian ABS, the 4 deals that we have seen done in Canada, we always have a lot of investors interest from U.S. investors because there is that huge, that relative value play for U.S. investors. However, a lot of these deals, most of these deals, and both Eagle and Glacier are to Canadian investors only. So when I look at Ford and GM, both of those deals could have been done just with Canadian investors. But we did have a good amount of also U.S. investors that helped to drive in the spread and bring the spread in, which is good from the issuer standpoint, not as good from the investor standpoint because they want that widest spread. You know, it's a shame we didn't see as many ABS investors come to market, and I know we'll get to this in a minute, but I really do hope and expect that we'll see a rebound and a back to normalization for 2021. Did I miss anything from your questions?
Yeah, no, definitely. Terry, did Susie miss anything, or how was your experience been from a TD standpoint?
No, I would wholeheartedly agree, as always, with everything Susie says. But the performance of the U.S. ABS market, just unbelievable. And I was disappointed, but issuers are doing their funding plan in advance, and at times the Canadian market has not been as reliable. So like Susie said, I could see where some issuers, set up private transactions rather than ABS transactions. But the U.S. market, as Susie said, just looking at Toyota as an issuer, their last transaction was well inside of their spread levels for their February pre-COVID transaction, and with underlying rates at the levels that they're at, the all-in yield for Toyota was like the best they've had in 10 years, sort of thing. And so I was hoping to see that translate to Canada. And again, the Ford Fast transaction is a good example. It priced right on top of its 2019 transaction, as Susie said, their largest issuance in Canada. They didn't upsize, but I'm sure they could have. So I'm hoping, the Canadian market was off, I would say, about 50%, as you guys have indicated. So I'm hoping we get a return more to normal in 2021 when some of those issuers that did private transactions rather than public this year hopefully return to it.
Yeah, and I would add to that. Sorry.
Oh, go ahead, Susie.
Do you want me to wait?
No.
I was just going to say that, I think similar to what Terry said, that these issuers that might have come to market did not see the spreads compressing very quickly. If we look at when our deals were, our first third-party ABS got done, that was the end of August. So if you're doing your planning in July for the fall of what your plans are for your issuance, and spreads are still dramatically wider, you're not going to plan an ABS deal in Canada if your spreads are still wide and you haven't seen a third-party ABS come to market. If you don't want to or need to, you might go and plan on ABCP or some other source of funding. So it's I think it was great that those 4 issuers did come to market because, as Tim says, they got lowest all-time coupon. But if you had any hesitation and were worried about a second wave or anything like that and didn't want to take that potential of a risk, which didn't turn out to be a risk, but it could have been, nobody knew, then it doesn't surprise me that that there's some issuers that did wait.
So it wasn't a case of issuer preparedness in terms of being able to answer questions or new data requests from investors or launching, and purely pricing issue.
Yeah, and there's a lot of issuers that are also, it depends whether you're focused on all-in yields or coupon or whether you're focused on the spread. And there's a lot of investor issuers that have hedged the Government of Canada curve. They don't care about they care, but they don't really care as much about the underlying yield. They care about what is that spread to the GOC. And if that spread is still relatively wide, they want it to come in tighter before they're willing to come to market.
And again, my hope was seeing the spread, how spreads were tightening pretty much from when the U.S. ABS market opened up at the end of April. Each successive deal just had tighter and tighter spreads. And it really didn't even matter who the issuer was. It was just, there was that much demand. And I was hoping that some issuers would look at that and maybe take a chance that the same thing would happen in Canada. And again, there was the spread compression that Susie's talked about, but by then funding plans were in place and other alternatives were used.
I should mention the chat. Anybody who wants to ask any questions, the chat function can be used. I'm not sure I'll know how to work with it, but at least make a try if you have any questions. It's in the Q&A section. So I guess in terms of outlook, we've seen, it's refreshing to see that performance through this whole year has been pretty strong. Obviously, that combination of structuring and unprecedented liquidity in the market from the government's quick reactions. They had all that stuff prepared before the end of March. I think it was March 23rd or something like that. That all that liquidity was available, and all the banks took advantage of it, as you saw through that covered bond record issuance. In terms of the outlook, so sounds like maybe, Terry, back to normal even before the vaccines are out.
Yeah, in terms of, I think when we talked about this particular section, we talked about what's going to be the lasting effect in terms of on transactions, and I think we've already got an answer to it. We're seeing, by looking at the U.S. ABS market, we're seeing transactions now when the immediate response when the ABS market opened up again towards the end of April, the immediate response was to increase what had been kind of a 25 beeps cash account to a 1% cash account. And in recent deals, we're seeing that go back to 50 basis points and getting back to normal. So I think in terms of, are some of these provisions going to become permanently part of how we structure deals, or are we going to return to pre-COVID sort of structuring and terms? And I think it's, from my perspective, very clear we're going to return to the pre-COVID, because again, we're seeing that again. And as well, Tim, I know we talked about this. I think DBRS recently rated an auto loan transaction, and I compare that to an auto loan transaction on the private side that we completed in April. And again, there's every transaction is unique and has different factors at play. But the more recent deal that private deal that I saw got rated, I noted that the hard enhancement in the transaction, from what I could tell, was like 2.5% OC and 25 beeps of cash. Whereas I contrast that to a transaction that we did in April when people were still trying to wrap their minds around, okay, what is the impact of this going to be and what sort of risk? We did a transaction that had 8% OC and I think 1% cash. So, consistent with what we're seeing on the ABS side, and I think also on the private side, we're as people realize, through government programs, these programs are going to perform. We will start to go back to the pre-COVID sort of levels of enhancement and terms, which I think is a good thing. We've now come through two crises where Canadian ABCP transactions and ABS transactions have performed very well, have been structured. So I think it's a compliment to the agencies and to the people who are structuring these transactions that through two significant crises, significant gaps in our structuring and the terms that we put in place to protect investors have not been discovered, and we're able to, once we get an appreciation of exactly what we're dealing with, we're able to go back to these standard sort of terms that have been working.
Thanks, Terry. Susie, did you have anything to add, or?
No, I was thinking exactly the same thing. It just reconfirms the way we've structured the transactions. And many a conversation I had with investors, I said, this is why we structure transactions. It's not one-time stress when we structure transactions. It's 3, 4, 5 times stress on your losses. So we have to have tremendous amounts of losses. And then when you go into the actual structure of your underlying ABCP conduits, what does your liquidity cover for? And how much losses can you experience in liquidity that liquidity won't cover? Or in our case, program-wide credit enhancement. So when would the first dollar of loss be to the underlying investor? It's tremendous. So it just reaffirms our structuring is solid.
Well, thanks. I think we're pretty much at the end. We did have a question for the presentation, so we'll get that out and put it up as following this session. So Susie, Terry, Paul King, thanks so much for adding a lot of value today.